collection of assets, and it's a very unique portfolio of businesses and assets involved in different aspects of energy efficiency, servicing a range of customers, from industrial to government in principally the US, UK, and Europe. And since launch in 2019, see it's paid a covered and steadily rising dividend, and broadly speaking, its portfolio has performed well at an operational level. But the trust sits on a very wide, an exceptionally wide discount of over 40%, and given that, and given that it's operationally performed very well, we think this trust deserves some of your attention to kind of get under the hood and understand what's going on, and why the yield is so attractive, and what the growth opportunity is as well. Before I hand over to Tamsin and Ben to get into the details, just very briefly for those who are joining for the first time, there's a Q&A box in the bottom right hand corner. You can type your questions in there. The only people who'll be able to see them are us, and so if you have any support questions as well as questions for the managers, do put them in the box, and we'll try and help you on those. Tamsin and Ben present for perhaps 20 or 30 minutes, and then I'll ask some questions after that, and we should go up to about 45 minutes in total. And the presentation will be available to download and to watch back on our website later. And so with that, let me hand over to the See It team to run you through this unique trust.
Thanks, Alan. Hello, everyone. So as Alan mentioned, we work at SDCL, who is the manager of the SDCL Energy Efficiency Income Trust. Ben, my colleague, is the head of asset management. He's also one of the fund managers. And he will be able to give you quite a lot of detail on the assets that are within the portfolio. I'm also part of the fund management team, and I have more of a focus on shareholder engagement and working with our board of directors. So between the two of us, we manage the day-to-day operations of the fund, along with the support of a much wider team here at SDCL. I'd like to start with an overview of the portfolio and the investment strategy before digging into a little bit more detail and handing over to Ben to talk you through the assets. So See It is an operating and developing in the energy transition's largest and underserved market. That's by that we mean that we are investing into products and services that make the generation, distribution, or use of energy more efficient. That's incredibly important because there are no net zero plans or decarbonisation plans that don't rely heavily on wasting less energy as opposed to simply creating clean energy. On the left-hand side of this slide is an overview of the portfolio as it is now. It's a large and diversified portfolio with a really strong balance sheet. It focuses on energy efficient solutions for buildings, industry, and transport customers across the US, the UK, and Europe. It's approximately £1.5 billion. About 2/3 of that is equity and 1/3 of that is debt. Of the debt, that is split between the bulk of it is amortizing debt at the project level, so sort of at the underlying holding level, and that is closely matched to the duration of the assets, and it's about 80% of that amortizes down, so sort of in a do nothing scenario that would reduce. And then about 1/3 of the debt is held up at the holdco level, so company level debt. It's in the form of a revolving credit facility from which we can draw down to fund the assets within the portfolio before replacing that through a number of means whether that be raising additional capital or making a disposal or using project level finance to reduce the level of the RCF. So that's very much designed to be a temporary debt facility. That portfolio is split across 10 countries, the majority of which is in the US. We have approximately 50,000 underlying customers across 50 projects, with an average contract life of around about 16 years. So you can see it is a very diversified portfolio, but with long-term stable revenue generation capacity. So despite that, on the right-hand side of the screen, you can see that this is an investment trust that is operating in a distressed environment. There is significant dislocation between the net asset value of the underlying portfolio versus the share price. As of a couple of weeks ago, when this slide was put together, the discount to the underlying value of the assets was at around about 45%. And at that discount, that generates a dividend income yield of around about 13%. So those are fairly big numbers, but that's in the context of an implied gross return of the portfolio of approximately 11%. When I say an implied gross return, that's sort of based on unwinding the discount rate that is used to value the portfolio. So if you assume that the debt levels are maintained at the current levels and the amortizing portion of that debt is continued to be refinanced, so we continue at the same sort of debt levels, that would imply an 11% return on the portfolio. So if you happen to have been a shareholder from the early days, that's clearly not an ideal position for you to be in, but it does present a significant opportunity at the moment if you are interested in purchasing shares now. So moving on to the next slide, a little bit of an overview of what we mean by energy efficiency. So on the left-hand side of the page, you can see that we're looking at energy efficiency, meaning simply using less energy to create the same outcome. Now, that's quite an important distinction because it means that we are both cutting carbon, but also cutting costs. So unlike a traditional renewable energy portfolio of assets, these assets are by their nature commercially appealing. I'm not saying that renewables aren't necessarily commercially appealing, but that it is a bit of a distinction that separates us from some of our peers. So one way to understand energy efficiency, we find it helpful to split that into two categories. We've got energy generators and energy savers. So energy generators address where the majority of energy is lost through the system, and I'll come on to some more details about where energy is lost in the system, but ultimately the generation of energy is an opportunity for tremendous savings. So the right-hand side of our page can see the top box, which relates to the energy generators, and within that are 5 assets that are our biggest 5 assets, and all of them are very focused on the generation of energy at or closer to the point of use. Energy savers is, the energy saving light bulbs or electric vehicles, charging electric vehicles. So this is very much sort of at the point of use, saving energy, and you can see a couple of examples: an electric vehicle charging network and Future Energy Solutions, which it supplies and maintains low energy light bulbs. So that's how you can think about energy efficiency within the portfolio, and I'll give you a bit more detail in a moment. But moving on, so while it's a very diversified portfolio, and while you can think of it as the savers and the generators, actually throughout the portfolio it's incredibly consistently structured. So the projects within the portfolio were either built or bought to generate revenue that is uncoupled from power prices. We have creditworthy counterparties across the entire portfolio who receive reliable and cost-effective energy services in exchange for long-term contracted revenue streams for SEIT. Some highlights about the nature of those contracts on the right-hand side of the screen. You can see that we don't have any unmitigated exposure to merchant power prices. So regardless of the wholesale cost of gas or electricity, that doesn't have a significant impact on the revenue generation potential of the assets within the portfolio. The solutions are commercial solutions, as I've already touched on. They're not dependent on subsidies. So in an environment where subsidies can be reduced or increased, that does not generally have a significant impact on our portfolio. Ben will come to this in a moment, but there is one exception to that. So we can talk about that a little bit more when we get to the assets. The projects selected with the opportunity for upside potential. So this is a portfolio that was designed to have a solid and growing income generation, but it was also designed to have the potential for significant NAV increases. So throughout the portfolio, Ben and his team work really closely with the management of the companies that we invest into to identify and drive their growth strategies. So this is both income and total return. It was built with relatively low levels of gearing compared to the traditional infrastructure peers. So we currently have about a third of the portfolio as debt. You will find, if you look at the kind of project level debt of some of our peers, that can be significantly higher. And finally, we manage our inflation linkage throughout the portfolio. So we are slightly positively correlated to inflation. So in an environment where you may see inflation rising, that will help us. So I've touched on the fact that there is a significant discount to NAV. I wanted to include just a little bit of detail about what we're doing to address that. So I will let you come to your own judgment as to the causes of that significant discount. Our belief is that it does not represent what is within the portfolio. The market conditions that we are faced with mean that most of our peers are also trading at a significant discount to net asset value. This is largely driven by a high inflation and high interest rate environment and some of the knock-on effects of that. However, there are levers available to us to do everything within our power to address it. So we very much hope that the sort of 6-point plan addressed on this slide will, in the short to medium term, serve to help reduce that discount and increase the share price. Just briefly running through those. On the left-hand side, in the light blue box, we talk about our efforts to reduce short-term debt. So that revolving credit facility that I mentioned earlier, the feedback that we have had from our shareholders, as well as just common sense in the current market environment, is that you do not want to have a lot of short-term debt. So we are working to reduce that. We can do that through a number of ways. Firstly, by managing the levels of debt to make sure that it is better linked to the duration of the underlying assets, but also by making asset sales to materially pay that down. And we are addressing both of those avenues. So the second box, the darker blue box, is relating specifically to the disposals. So we have already made one significant disposal in May of 2024, and we've made public announcements about some formal process that we have in place at the moment to potentially make another sale. The intention is that that would materially pay down the RCF and also serve to prove the net asset values of the assets within our portfolio. Indeed, the sale of UU Solar in May last year was for a small profit, so we were very pleased to be able to announce that. The third box on the top row, the dark blue box, is relating to our capital allocations policy. So in the current environment in which it's very difficult to go out and raise additional capital, we have had to be far more focused on our use of the capital that we do have available to us, and our board are very focused on that. We have a robust process in place to ensure that everything we allocate in this environment is to something that can be demonstrated to beat the thresholds implied by the alternative of buying back shares with the capital that's available to us. So you can sort of follow the calculations based on whatever the current share price is. We did those calculations for the 30th of September for the purposes of this presentation. So that number is actually a little different now. The discount is greater than it was in September, but at September's share price, that implied a hurdle of circa 13%. So it's a little bit higher now. So any capital we've been deploying over the last year or so has been materially beating a mid-teens hurdle. So onto the bottom row, we have been actively managing gearing levels on the balance sheet. So we are always looking at ways to refinance for better terms, but also to better match the debt within the portfolio, as previously mentioned. The orange box relates to the work that Ben is mostly focused on to do everything we can to increase the value of the assets. Of course, an increasing net asset value is the best possible driver of an increasing share price. So that's always front and foremost for us. And then finally, increasing the liquidity of the shares and the marketability of the shares. We are incredibly focused not only on presenting to the likes of yourselves, but also in talking to a broader range of institutional investors and working hard to bring new shareholders onto the books in order to support ultimately support the share price as much as we can. So just to give you a little bit more information and background on energy efficiency, for those of you who are not familiar with energy efficiency and why this is something that is such an exciting investment opportunity at the moment. The problem across the top of this page is that an absolutely shameful amount of energy is lost globally. This isn't specific to Europe or the UK or the US, it's globally. Approximately 55% of energy is lost during the process of generating it. That's largely in the form of heat and steam that sort of gets wasted into the atmosphere, and only a smaller portion of the energy generated actually gets captured. A further 5% of it gets lost through inefficient grids and the distribution process. And then finally, of what's left, anything from 5 to 95% of that can get lost at the point of use, whether that's through inefficient light bulbs or very inefficient combustion engines running cars. And so on. So there are lots of opportunities throughout that system to reduce the loss of energy and thereby materially reduce the carbon emissions of the system. So we've worked very hard at that. Some of the big stats for the financial year ending in 2024 was that we generated approximately 5 million megawatt hours of power, and we saved just under 400,000 megawatt hours of energy at the point of end use. So we are having a sort of significant and meaningful impact on that. And finally, whilst the market environment is really not particularly conducive to the share price in our sector, and it has presented quite significant issues for our shareholders and also for the market as a whole. In actual fact, the macroeconomic conditions that create that are ironically quite conducive to customers being taking more of an interest in finding ways to be more energy efficient. So the high energy costs and market volatility in the market, that's a strong tailwind for customers choosing to choose a more reliable and cheaper source of energy, ideally on site. concerns about energy security, the kind of macroeconomic, macro geopolitical environment with what's been happening in Ukraine particularly has had a material impact on energy security, and having a more stable and reliable source of energy generation on site is particularly appealing. The focus on mitigating the impacts of climate change comes in and out of favour, understandably, but that is a sort of ongoing structural trend that isn't going away, and that's very much supportive of energy efficiency. And finally, policy, particularly in the UK and Europe still, things have been shifting a little bit in the US, but ultimately, as mentioned, that's that ship has already left the harbour, and economic support for cleaner and cleaner production of energy and more efforts to decarbonise, that's not going away. So moving on to the track record, I'm going to hand over to Ben, who can take you through some of our track record of performance.
Yeah, thanks, Tamsin, and good to talk to you all today. So just to start with track record and performance, and the performance of the company of SEIT is driven by the cash flows of the underlying performance of the investment companies and that sit within our diversified portfolio. We've, in our opinion, got a very strong track record of these cash flows since the listing. You can see here on the left-hand side the cash flows generated and brought up to SEIT from these companies. Last year, in financial year 24, that totaled 92 million. And the first half of this financial year, we were at 48. And you can see the progressive growth of that whilst we've been growing the company. And you can see again on the left-hand side, the green line at the bottom, you can see that that's been very steady in relation to the average shares within the company itself. And then moving on to the graph on the right-hand side, sorry, I can just flip back. Moving on to the graph on the right-hand side, you can see, it's this cash that we're generating in the underlying portfolio that covers the dividend. So I think we had a question about how's the dividend covered. It's from the cash generated from the underlying portfolio, and we've maintained a good, healthy cash cover. And again, I think we've also had a question about maintaining the dividends going forwards, which is very much the plan. You can see here on the right-hand side, we've been paying a progressive dividend through the years of the fund, and that will continue. It's very much the plan, and that's what's forecast, and on the same basis in terms of the cash coverage from the portfolio and from the cash generated from the companies. So if we move on to the next slide, just in relation to what are these investments, what are the companies generating this cash? We've mentioned we've got a very diversified portfolio, and that is extremely intentional. But fundamentally, these investments are built on the same foundations as what Tamsin mentioned earlier, in terms of the long-term contractual nature and the commercial solutions being delivered to the customers with credit-worthy counterparties. So starting, I'll go through some of the main investments that we've got. Again, Tamsin mentioned the two categories: energy generators, energy savers. So to start with the energy generators, starting with Onyx. So Onyx is a company that delivers low-cost renewable power for commercial and industrial customers. And how they do that, they develop and install and operate behind-the-meter solar and storage solutions for commercial and industrial buildings. So the company owns its own portfolio of assets, and we also have a highly experienced management team within the business and a very strong pipeline of projects as well. So pairing that together, we're currently developing sites in 35 states across the US, and we're already operating sites across 14 states in the US. And obviously, this is a big area of potential growth. There's been significant growth within this company year on year in terms of the deployment of these solar sites. In the last 18 months, we've tripled the run rate of the business. At the moment, we've got about 260 megawatts of sites that we own and operate, and we have contracted. So this particular area where we see really significant growth, we're very excited about that, and we're looking to support that business going forwards. And then staying in the US, but moving on to Primary Energy. So Primary Energy is a company that supports the hard-to-abate steel industry in the US. Obviously, it's very, very important industry to the US economy. And we're working there with household names such as Cleveland-Cliffs and US Steel. And as an engineer personally, this is the one, this is a particularly nice engineering solution, pretty great benefits to US Steel and Cleveland-Cliffs. What Primary Energy does is take the waste gases from the steel mills, from the blast furnaces, the waste gases coming off the top. We recycle those and we turn that back into power and heat that is then returned to US Steel and Cleveland-Cliffs and used in their process. So we utilize their waste gases, so we mitigate their exhausts effectively, and then we reduce their energy consumption needed from elsewhere by recycling that energy back to them. So it's a very, very neat solution. We've got a very experienced team there as well that are very much focused on continuing the performance of the business, which has been very strong and being very reliable. We've got various accretive projects that we're looking to deliver cost savings that will benefit us and add value to that investment. And for example, some successes in the last 12 months, we refinanced that business and improved the amortization profile of that debt, and hence improved the distributions back to SEEIT itself. And we also recontracted one of the major contracts with the customers, extending the life of that contract for another 10 years. So, which is very much the hallmark of what we're trying to do through active management of these companies. Moving on to RED-Rochester, still in the US. So RED-Rochester is in upstate New York. So we own the district utility energy business that is supplying 16 different utilities to about 120 customers on a business park. So we have a range of customers there, industrial customers who are using lots of different energy services, everything from the very typical in terms of power and heat, different grades of steam, compressed air, to the slightly unusual in terms of different compressed gases and brine water and things like that, and also wastewater services. So a real plug and play, one-stop shop business park for different utility needs of different businesses. So this business is supported by a long-term tariff contract with all of its customers, which means that we've got long-term certainty over the revenues of that business. Also, one thing that's really attractive about RED-Rochester, which is a very active work stream, is bringing new customers into that park. There are vacant sites on that park, and if we can bring them into the park, we can increase the demands on our systems, which we have capacity for, and therefore we can increase the revenues to RED-Rochester and therefore the value. As well as that, we've got a very long list of accretive projects that we want to deliver, which is all around delivering cost savings predominantly. We just last week we turned on a new gas turbine, $85 million in the US project, cogen project, to install a new high efficient gas turbine on the site, and that's all around delivering the same services to the customers but improving the efficiencies of our own systems. So there's, clearly there's environmental benefit to that, but there's also cost saving benefit to that, and we benefit, RED-Rochester, and therefore SEEIT benefits from that. So yeah, very exciting moment in the program of that project, turning that gas turbine on last week, which will be delivered and fully operational in the near future. And then moving across the Atlantic over to Europe, so SEEIT Oliver. This is our circular economy investment, which supports the olive oil industry, which in Spain is a very, very important, very historic and traditional and long-standing industry in Spain, in the south of Spain. And the production of olive oil requires a huge amount of heat. Previously, decades ago, they used to burn olives to create the heat to dry the olives, which isn't particularly the cleanest and most efficient solution. So what we own is a portfolio of highly efficient engines and gas turbines that generate that same heat, replace the need to burn the olives, and we provide that heat direct to the olive oil production system. So that's very much what the solution is, but also at the same time, there is a waste byproduct that comes off that process of producing the olive oil, and we also utilize that to generate renewable energy. So that's why it's a circular economy solution, because we are providing the heat and the power to run the olive oil process, but we're also processing the waste from that process and turning that back into renewable energy. So this one involves a lot of active management. We've actually bought energy procurement teams in-house and feedstock teams in-house, and that's all around risk mitigation and making sure that we can control and manage that company and the different risks involved with that business sufficiently. And looking forwards, we're also looking at complementary business opportunities there in terms of things like the biomethane market in Spain, which is developing pretty rapidly, and we're very well placed to take advantage of that going forwards. And then moving on to Driva, so this is our biogas grid that we own in Stockholm, in the capital city of Sweden. So this is about 85 to 90% biogas content, which I think is, at least by my records, is fairly unrivaled from what we can find. So really significant quantities of biogas that are being distributed around the city of Stockholm. We deliver it to around 50,000 customers. That's a mixture of residential customers, but also commercial and industrial customers as well. So very long-standing business, looking to drive that biogas delivery, that green gas delivery through the city of Stockholm. But also what we're now looking to do, we rebranded that company last year, and that very much signifies the start of a new strategy where we're looking to leverage a few things. One, the customer base of Driva, but also the team that we have, the highly experienced team that we had in terms of delivering energy infrastructure. And we're looking to diversify that into other markets, so delivering other energy as a service products, very much similar to what Onyx is doing in the US in terms of behind the meter solar, and what EVN will come on to we're doing in the UK in terms of EV charging and other energy as a service products as well. So there's a good kind of growth potential and pipeline behind that business moving forwards as well. So these are the 5 main energy generators in the portfolio. We have more, but between all of these investments, they cover about 75% of the portfolio value. And as I said, they fit into the energy generator category. So moving on to the energy savers, as Tamsin mentioned, this is all around reducing the demand of our customers. So I mentioned it very briefly earlier, EVN. So we have a portfolio of ultra-fast chargers, EV chargers in the UK. We've currently got around 30 operational sites, and again, another pipeline of projects in construction and in development. And there we are working with household CPOs, so charge point operators, the companies that you will interact with if you have an electric car and you use these chargers. So we're working with the likes of BP and ESB and E.ON and companies like that. The great thing about this is that we see it take no utilization risk. So our revenues are fixed. They are the same whether the charges are used or not. So it's great from that point of view in terms of risk mitigation. But also this is an investment where we have a pipeline of projects which we're looking to deploy going forwards, and hence try and grow that platform out. And then there's a few other examples, but a couple of other notable mentions is Future Energy Solutions, FES, and Spark Fund, both in the US, both around delivering highly efficient equipment to customers. So FES is lighting, Spark Fund delivers lighting, but also other highly efficient cooling services and things like that. And it's a very neat solution in that we deliver these systems into the customers. They don't have to pay for the capital, that's what we do, and then they pay us back through the savings that equipment is generating. So it's a great solution for the customers, and it's a great solution for us in terms of the structuring. And that there's large untapped markets in the US where we're looking to expand into going forwards. So we'll move on, but that gives you a little bit of a flavour for some of the investments in our portfolio, and hopefully some interesting ones. So thank you for moving on. So on this slide, what we wanted to highlight is, obviously we're an income trust. We're very much focused on yield and income, but we also make very conscious decisions to make investments into infrastructure and businesses that we can add value to over time. So we're very much focused on the total return aspect of the investment as well. There's different ways that we can do this, which are outlined here on an illustrative basis. So very much we work with our businesses to try and reduce costs, drive efficiencies. I mentioned some of this earlier in terms of, at Red Rochester, we have a long list of projects where we want to reduce our cost basis, improve the efficiencies of our systems. We bought certain gas procurement activities in-house at Oliver, for example, and that allowed us to bring our costs down. And also we're delivering other efficiency projects at places like Primary Energy, for example, and we're well on the way to delivering those in the next 12 months. And we have a list of other projects that are following them pretty quickly. Also, we're looking at other opportunities to invest in high return projects and also add new revenue streams to the existing investments. So, for example, I mentioned earlier Primary Energy. We recontracted one of the main sites and extended that revenue line for another 10 years. And I also mentioned the Red Cogen project, the $85 million project. And that is an opportunity to put more capital to work within the existing investment and generate high returns off the back of that. And we have a reasonably sized shopping list of other projects from the existing portfolio where we are looking to do that going forwards. And then the other aspect is platform value. So I've mentioned the likes of Onyx and EVN. We have existing assets, but behind them is a development platform, and we are developing and deploying a pipeline of projects there. And very much driving platform value through the deployment of that technology and those projects in their pipeline. And these are all the ways that we can either put our capital to work or put our management teams and expertise to work in order to drive value to the shareholders. So I think just to sum up, we won't kind of repeat all the nitty-gritty detail, but just to touch on a few finer points before we open to Q&A very quickly. But we have a very large and diversified portfolio, as I said, very intentionally designed in that way, which is generating strong cash flows, reliable cash flows, and that's what we see going forwards. And I've alluded to, more specifically that we are very active in terms of hands-on management of this portfolio. There's a lot of value there to go after, which we're very, very focused on delivering through the existing portfolio. And that's what we do through the hands-on management of the portfolio. And ultimately, what we're about is driving the growth through this in order to deliver value to the shareholders, and that's what we remain focused on going forwards. So with that, I think I'll hand back to Alan, and we'll be happy to take questions.
Thanks, Ben. There's a question about valuations, and obviously this is a recurring theme for investment trusts that invest in private assets, and I think most of our viewers will understand that there are commercial sensitivities about disclosing individual financials for all of your companies. But do you want to talk a bit about the way that you value assets, the process, and how you get external inputs into that, and how, as well, obviously with some realizations not only in your portfolio but in the sector, you can start to see kind of evidence after perhaps a hiatus for transactions. So there's plenty of data that goes into valuations, isn't there? Do you want to give people a little summary of that?
Yeah, can do. I'll start off, and then Tamsin, obviously feel free to chip in. But generally speaking, all our valuations are based on DCF, so discounted cash flow models. So we project those cash flows out for the remaining life of those assets. And so they are obviously driven by assumptions that we work with very closely with our management teams and obviously with our internal team as well. I think a few important things that I would stress. One is that we take a lot of third-party input and advice on that, whether that is independent input on discount rates market discount rates and discount rates specific to each investment. And also, we also go to independent valuation teams to give us a third-party valuation on specific investments. So, for example, I think at our March 24 results, we had about a third of the portfolio independently, externally valued, effectively to verify what we were doing from a valuation point of view. And you know, the last point I'll make is kind of needless to say, our valuation process generally is very robust. It undergoes quite a lot of scrutiny from an audit perspective, as you would expect. So we work very closely with our auditor to make sure that there is very strong and robust evidence for assumptions being made in those valuation models, and that's all signed off from an audit perspective. So yeah, hopefully that gives some insight into the valuation process itself.
Yeah, the only thing I would add to that is sort of touching back to the point that I made about engaging with our shareholders, and sort of a lot of what that means is trying to better understand which disclosures and what we can share to better help analysts and investors to sort of model for themselves where they feel the valuations are, and to be able to help them to compare us to not just our peers, but so other types of investments out there in the market. We understand that actually in many ways we're a lot like an operating company or a listed operating company, and you'll see very different disclosures from those. So we've been making steps wherever possible to provide the information. We've sort of started to give a bit more detail on the EBITDA of the individual assets, or the largest of our assets, and we're sort of looking at an aggregated sort of portfolio-wide EBITDA. It's the hope for the next round of disclosures. So we're working towards it. These things take sort of some shifts and some changes to the way that we produce things, and we've obviously got to get board approval for anything that we do add to our disclosures, but that's all in an effort to help give some comfort to the valuations that we're putting out there.
Yeah, and I think I'd point viewers to the report and accounts, which I think has got some good market leading disclosures on certain things like gearing. So you know, it's a work in progress for the whole sector, but disclosure is definitely improving, I would say, as an observer. I'm not gonna avoid the Trump question because it's come up in the thing, and we knew it would. And I think everyone watching this can indulge you if you want in a little bit of speculation, but I think given the nature of some of your assets, I think you can make some robust statements that could well, I'll just leave it at that and pass it over to you.
Yeah, of course. Thank you. Yeah, it's something that's coming up a lot for us at the moment, and it is completely understandable. The announcements that have been coming out of the US over recent weeks have, some of those are specifically targeted at sort of paring back support for clean energy, and sort of rethinking their approach to the generation of energy and energy security within the US. So of course it's understandable that there are concerns of what the ramifications are for us. So the first thing that I'd like to say is that this is something we are laser focused on, not just within SDCL amongst the team that on the desk here, but at each of the portfolio companies that we work with in the US and actually in Europe as well, but more so with the US management teams. This is something that they are paying very close attention to identify anything that has the potential to have a meaningful impact on us. That said, the nature of our investment thematic is that we are investing into things that ultimately are commercially viable, and therefore we're not dependent on subsidies. That there are areas where there are there are some exposure to some subsidies, but within the US, none of our assets are dependent on subsidies. I'm slightly loath to give too much detail. There is actually a note that is going to be published in the next day or two on the SDCL website that will give a little bit more detail. But ultimately, whilst there are a couple of areas that we are watching very closely, at this point, we haven't come up against anything that has the potential to have a material impact on the US assets.
Perhaps more.
Anything can be announced. We don't know what's coming next, so
yeah,
this is very much as of today, but the impact is limited for now.
Perhaps more simplistically, to my simple way of thinking, providing energy efficiency to the US steel industry seems like it's on trend.
Well, yes, of course.
I would say.
The tariffs on steel for the US clearly have significant positive potential for primary energy.
I think, Alan, it's a really, really good point. So it's worth just kind of stressing is that, okay, but kind of very facetiously, kind of people are talking about Doge and government efficiency and things like that. But efficiency is clearly part of what the new administration is trying to achieve. So yes, okay, they have particular thoughts on how they do that, and let's not speculate too much on exactly how they might do it. But we should be aligned. There should be opportunities there going forward. Yes, they are, looking after their own in terms of the steel industry very much, and we would hope that would be a positive, and that's what we expect for us in terms of primary energy. But generally, kind of thematically, yes, I think that there is good alignment there. Exactly how that comes out in the wash, we are keeping a very, very sharp focus on, as Tamsin mentioned.
Yeah, there's a very difficult to answer but very fair question on which I think, given the discount, I think it is fair to try to answer. I would preface that by saying it is quite difficult to answer, but see it 40+ discount. Taking another example, Greencoat UK Wind 2025. Why do you think there's such a big gap between the two? When you look at the dividend cover and the dividend growth and the asset diversification, there's lots of things to say this is inexplicable, but I think there are some reasons. But I'll let you speculate or before.
I mean, I think we veer quite firmly into the realm of opinion here, so I can't really sort of.
I think that's totally fair. Everyone understands that you have to have an opinion, and that's what this is.
Absolutely. So I have an opinion. My personal opinion is there are a handful of reasons that we can point to. The first and the biggest, in my view, is the fact that we are very different to the likes of UK Wind insofar as we have a range of technologies. We are across a broad spectrum of industries and commercial environments, and these assets are different to each other. There are ways in which they're really consistent. We have this business model that we look for or we build, and that means that there is a degree of consistency and uniformity within the portfolio, which helps us in managing it. But ultimately, for an outside person who wants to come and take a look at us, or they want to come and take a look at UK Wind, we are more complicated. And we're working hard to find ways that we can deliver the information and convey the portfolio for people to understand it as a whole, and what the big drivers of performance of the portfolio are, so that it's not so complicated to understand. But you can go away and you can work quite hard to understand SEEIT, and you will at the end of that time understand SEEIT, but you won't necessarily understand any other portfolio. Whereas if you take the time to understand a wind portfolio or a solar portfolio, you're going to pretty much understand all of the peers out there. So I think that's first and foremost the reason. I think we're a bit more unusual, and that's both our strength and a disadvantage in this regard. I also think, you know, if we're really being honest, I think that the market would like us to have reduced our RCF faster than we have, and we have, again, because we are different, we have continued to use it, and we stand by that decision, and it's something we've spoken at length with our board about, and we've had a lot of feedback about it. But it's something that we've done to continue to support the growth of Onyx, which is the US solar asset. So they have been a fast growing asset. We've done that knowing that we are going through a formal disposal process, which both pays down the RCF, but also means that we no longer need the same amount of capital to continue to fund it. So I have the view that could have been the one thing that we could have done faster to bring the share price up a little bit. I mean, though that's my view on the two big reasons. I don't know, but perhaps Ben has a different view or would like to add to that.
I think you covered it nicely, so nothing to add. I have a very similar opinion.
Good. Thanks both. We are over time, and that's okay. And I think there's probably another hour's worth of questions. So I would just wrap up by saying, whilst some of our viewers probably do want more disclosure always, there is a lot of disclosure on the SDCL website. There's a lot of information about the companies, and there's a note shortly to come out from Kepler simplifying some of those concepts down a little bit as well. So you can register on our website to be alerted to that. This presentation will be available to watch back, and the slides will also be available to download. And so with that, I thank everyone for attending, and I will see you on the next one. And thanks to Tamsin and Ben.
Thank you everyone for listening, and thank you, Alan, for hosting.